presentation contains current opinions of Moe Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Moe.
Hello everyone, and welcome to the Compak Asset Management Market Wrap YouTube update for October 22nd, 2021. I'm Moe Ansari, President of Compak Asset Management and host of Market Wrap. Thank you for joining me today. By the way, you can get the daily edition of Market Wrap, the 1-hour broadcast that I do every day, simply by going to the Apple Store and typing in Market Wrap with Moe Ansari. It'll bring up the app, it's free, download it, and then you can listen to the 1-hour broadcast. Great guests every day that I have, and my views and observations on a daily basis. Let's start with the markets. Looks like COVID is finally getting behind us. It's an endemic, not a pandemic. We'll have to learn with it, and we are learning. But the unvaccinated rates were way up here for the people who were 80 plus. It's coming down. People that were 65 to about 80, their rates were up. They're coming down. The vaccinated people who are, it's right down here for the vaccinated. This is for the people unvaccinated who were in their 80s, and it's 10% or lower. So if you are old, but if you're vaccinated, the chances are you could get sick, but it's still okay. You're going to live through it probably, even if you're 80 plus. And I think if you look at the mortality rates of people 80 plus who get the flu, their rates could be pretty high too. So now we're getting it back to a place where we know where to live with it, how to live with it, and we're changing with the booster shots coming. The efficacy rate, I believe, it's about somewhere around 90%. This is the 100K population by vaccine product, and if you are vaccinated, this is the number. The best one, by the way, is Moderna. The second best has been Pfizer. And the third best is Johnson & Johnson. That's what we saw with the numbers. So it's looking like we are finally getting the vaccination and getting the numbers high enough that we're getting closer and closer to herd immunity. Looking at the reopening where we are right now, new highs past, this is the post-COVID. Unemployment claims came way down, still higher than where they were in 2019, but they are the lowest since COVID. Same thing with continuing claims. This is where we were going into the COVID. This is where we are now, but still a new high for there. Staffing, we're looking at steel production. Steel production, by the way, is higher than where it was in pre-COVID. We're looking at passenger travel up to about 1.9. We're at 2.4. So we're getting there. We're coming back, and that's really what it is. I think as more and more people get more and more comfortable, as I had said 2 months ago, as we get to September, kids go back to school, we start finding a normal rhythm in our lives, and that's what we're starting to see. Market new all-time high. Has never been higher in history, as I always say on the radio broadcast. That's what we saw for the S&P this week. Dow, Nasdaq did not quite make a new S&P high, but I'll show you the charts and where we are. Seasonally, this is where we are. But if you look at a chart going from the Second World War to now, we go up go down in September, have a little bounce up going into the end of October. We get a little decline in the last week of October. Guess what next week is? And then we go off. We are going to see some problems today. Powell said it's time to taper. He's the chairman of the Federal Reserve. Time to taper. I think everybody expected it. If you've been tuning into this broadcast or my daily radio show broadcast, you know that I've talked about November 3rd. That's when they're going to announce the taper. The only question is the composition. They're buying $120 billion worth of bonds every month. That's what they do. They're expected to scale that back by $15 billion per month. So from 120, they're going to 105. The following month, they'll go down to 90 and so on. That's the expectation. They're going to buy $10 billion less of treasury bonds, $5 billion less of mortgage-backed securities. This is going to cause a little bit of trepidation next week again. Oh my God, what are they going to do? How fast they're going to go? And inflation, that's going to be, today he said the risk of are clearly now longer and more persistent bottlenecks and thus higher inflation. He thinks we can go to inflation probably into next year. I think, as I've said, if you've been listening to the broadcast for the last 6 months, a year, I mentioned the Fed is going to let inflation run hotter because that's the way you get rid of debt. If you borrow money and inflation goes up, you pay it back in inflated dollars, and that's how you decrease debt. Over the last 10 years, we piled up debt on top of debt. I think that's going to be the case. I think we'll get a little bit of nervousness. Are we going to get the social infrastructure spent? Are we going to get the hard infrastructure spent? As I said 6 months ago, again, I thought it was going to be $2 billion on the soft infrastructure or social infrastructure, whatever you want to call that, and about $1 billion in the hard infrastructure. I think we're going to get the $3 trillion. By the way, you know how much is $1 trillion? $1 trillion? If you start counting 1, 2, 3, a number every 1 second, 31,709 years. That's how long it would take you to count to $1 trillion. That's how much $1 trillion is. So we're not putting in $1 trillion. We'll have about $3 trillion. All of it doesn't come in at the same time. It's going to take time. It's going to trickle into the economy. But that will give the fiscal boost to the economy as the monetary tap gets tightened or closed a little bit, as the Fed cuts back on taper. The question is, when are they going to start raising interest rates? Everybody now is saying, oh, they could raise interest rates earlier than expected. I still think if you look at the futures market, we're about 75% probability that the first interest rate increase happens in September of 2022. We're a year away, folks. In the meantime, profitability this week, we are looking at 35% increase in profits this quarter compared to the last quarter of 2009. That's an incredible amount of money. Again, what I've been saying for years, for the last 30 years, you've heard the broadcast, I've talked about it. What drives the stock market is profits. The more money a company makes, the more valuable their stock becomes. Looking at the charts, we've started this wave count. This was looking like a wave 5 high and a correction, but it seems like it's just a small pullback that we saw, and we're on our way. This is the 5th wave Fibonacci target for the charts. That's the 5th wave target right here. First target is 46.75, and then we're looking at an extension, if we do get that, 47.75. We've gone straight up here. If you look at a shorter term chart, this is a 60-minute chart where each one of these lines, these vertical lines that you see here, is 1 hour of trading. This was 1 day of trading right here. Each one of these lines is 1 day. It's a daily chart. This is a 60-minute chart where every line is 60 minutes of trading. That's how I like this technicals. I've done it for 40 years. I used to teach it in the 90s, as some of you remember, and so on. But here we've seen wave 1 to the upside, wave 2 to the downside, wave 3. This is wave 4. We could see that pullback. It brings us down to somewhere around right about here, and maybe here is what I'm looking at. So if we do get hourly, this is 3-4 next week, and then we start again to the 5th wave high. That's what it looks like on the daily charts. On the weeklies, here's a chart, 3rd wave extension. We're looking at 46.75. Each one bar now is 1 week instead of 1 day or 60 minutes. This takes us back to 2017. This is 2017 right here. This is 2018. This is 2019. This is 2020. And this is 2021. So you can see the chart going back. You can see that this gives us a long-term picture. This was the COVID bear market. You've seen wave 1, wave 2, wave 3. Was this a 4th wave? No, it's just a little pullback right here like we saw right here. It doesn't qualify, but here's 46. Long-term target, maybe over the next year, year and a half, we could get to 5,400 for the S&P. I know people say, well, that's a lot higher than 4,400 where we are, 4,500 where we are right now. Yeah, it could be that, but it might take a couple of years to get there. This is a very long-term chart. Nasdaq did not make a new all-time high. As interest rates go up, technology companies, they don't have a lot of assets. They make everything online. They ship it online. You download it. They don't have physical plants. They don't have stuff. And as I mentioned, if inflation goes up, the price of stuff goes up. That's what we could see, and that's why I think technology is not doing as well, but still starting a wave count to the upside, wave 1 to the downside, wave 1 to the upside, 2 to the downside, and we're starting wave 3. Target initially is 16,000, and then there's another target at about 16,500. Those are the Fibonacci targets, technical targets that we're looking at. Weekly charts, just here's a weekly chart. Again, each one of these lines that you see is 1 week of trading, these vertical lines, instead of 1 day. And you can see that Was this a fourth wave pullback? Not quite. 16,600, 15,000, then 16,500 becomes the first target. That's the way I'm looking at the charts. These are my interpretations. This is my view. This is my opinion. Market does whatever it wants to do. You have to have the right mix of assets. That's the important part. Gold, again, came up, kissed the 200-day, could not quite close above it. With all the news coming out, all the nervousness out there, the market still could not take off to the upside in gold. Very disappointing. Support is right here, about 1720, 1700. Then this 1675 triple bottom that we saw last March, double bottom right here in March, and then another test of it in August. If we break 1675, that means the gold market would be in serious trouble. On the other hand, this is the small cap market. I equate this to the reopening trade. Small caps are reopening. As the economy reopens, that's where people start going out, restaurants, etc. It's been stuck in a range from here, which is about 2360, to here, which is about 2100. That's what we've seen in this market since the beginning of the year. And you've heard the saying, in technicals we always say, the bigger the base, the bigger the move. We've made a one-year base in the small caps. This is the downtrend line, the blue one that I've drawn, connecting the highs here, and we got above it this week. We broke out above it. That is the first sign. This is what is called a wedge formation. We got to the apex. We're breaking, looks like we're breaking out to the upside. Confirmation will be when we break out above this huge base about 2360. That happens, small caps head towards 2500. So that's where we could see the reopening trade, small cap value, emerging markets. We've had a great run in the large cap US markets. I think that's going to broaden out. Interest rates are headed higher. We made a bottom right here in July at about 1.10. Here we are today at 1.65. Target on my interest rates is 1.85. That's what I'm looking at. So interest rates could continue moving higher in the short term, but I think the market is ready to get interest rates a little bit higher. I think we can live with 2% 10-year interest rate. Yes, it'll cause some volatility in the market. I think, again, the easy money has been made. Next year and a half is going to get a lot more volatile. So having the right mix of assets, it's critical that you have the right mix. How do you know if you have the right mix of assets? Well, first of all, you have to have the right emotional mix. We find what is your risk number. This is like your speed limit that we do for you. It shows you within a 95% probability what is the worst case on the downside, what is the worst case on the upside. It's like a bell curve. The worst cases are here and here, tail events. Not going to happen that much, but it gives you an idea within a 95% probability what can happen. We talk to you, we ask you how much you can handle, 5%, 10%, we move it back and forth until we find your risk number. Once we find your risk number, then we match it to a portfolio. And that gives you that peace of mind where you can sleep at night comfortably. That's what you have to do. If you don't know your risk number, it's like driving on the freeway without a speedometer. You think you're going 30, first curve comes, you go off the cliff. What happened? Oh, I was going 80 miles an hour. If you don't know your speed, how do you know how fast you're going? If you don't know your risk number, how do you know what risk you have in your portfolio? That's where we can do that. Just give us a call, go to Compak.com, ask for a free risk analysis. There's no obligation, there's no cost. All you have to do is go to Compak.com and we will do this for free for you. Then we can show you a portfolio that we will do for you. All of that is free. And then you can make those decisions if this is something you would like to follow. Those are my opinions. Those are my views. Don't forget to subscribe. Click on the subscribe button. Click on the bell. It'll notify you when I post these updates. Have a wonderful, wonderful weekend. Again, remember, you can buy everything else except time. So spend it wisely. Have a wonderful weekend. I'm Moe Ansari. Talk to you next week.
This presentation contains the current views and opinions of Moe Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.